keeping with the Kiwi theme, we're reviewing the Kiwi Saver Scheme today. Started in 2007. This is a voluntary work-based saving initiative. I mean, let me just maybe kind of go through some of the fundamentals here, Collin. I mean, we're talking about something that started in 2007. It's voluntary, I suppose, is the first thing. So you don't have to contribute this as a New Zealander. And then, I mean, quite nicely, I mean, they give you kind of like 1,000 New Zealand dollars that you can kind of start with. I mean, that's a fantastic incentive to kind of keep this thing going. Is that correct?
What they've done with KiwiSaver, again, because you mentioned it's voluntary and they needed to get as many people into the scheme as possible, they've attached a lot of incentives to it. So the $1,000 kickstart is actually just very minor in terms of the other incentives that are paid. Is if you're an employee, your employer now needs to contribute into your KiwiSaver as well. So it's your contributions and employer contributions, and they're generally matching contributions, and plus you actually get a government contribution as well. And when KiwiSaver started, for somebody on the average wage, for every $1 that they put into KiwiSaver, they basically got $1.50 free. So it was very, very generous. And because of those generous incentives, a lot of people have joined. And what they've done is they've actually slowly reduced some of the incentives over time, because the whole idea of the incentives were to get people into the savings habit. And because they've achieved that now, is the government, and because governments have been under pressure as well, the government has kind of reduced some of the incentives. So it's not as incentivized as it was at the start.
And I suppose one of the great things here is the fact that you've got the private sector involved. You know, usually when governments try and manage these schemes and there's no private sector involvement from an asset management perspective, from a money management perspective, you know, you don't necessarily have the buy-in from the industry. Whereas in this case, you've got kind of the government saying, listen, let's get the private sector involved here, let's get it managed. I mean, look at your screen quickly now, and you'll be able to see kind of what's happened with membership as far as KiwiSaver is concerned. You know, starting in August 2007, you see how few people are actually kind of contributing to it, and you can kind of see how that has grown over time. And I suppose that's what you're trying to see in South Africa as well. You want to try and see more and more people kind of saving for the retirement and getting kind of a tax benefit for that. I mean, is that in essence what they're trying to do with KiwiSaver?
Yes, in KiwiSaver, the incentives have been the main reason that the membership has been so impressive, or the growth in membership has been so impressive. When you think about New Zealand, it's a very small country, total population of 4.3 million. You've already got 1.8 million members into KiwiSaver. And when you think that pensioners can't be part of KiwiSaver, your overall kind of total market for KiwiSaver is round about, and it changes who you speak to, around about 2.5 to 3 million members. So 1.8 has been a tremendous uptake in membership, and people have found it very, very attractive. And yes, it has been a lesson in terms of if you do provide good incentives for a voluntary system, people will take it up. Whereas in South Africa, it's slightly different. You know, for somebody joining a company, it's generally compulsory to join the scheme.
Yeah, I mean, and I suppose, Godfrey, this thing is probably much more likened to 401k that we're seeing in the US than it is potentially to South Africa, looking at pension schemes and then preserving and trying to then get an annuity out of that at retirement. I mean, would you say 401k is much more similarities just from a mechanism perspective?
That's actually a good way to look at it, because within KiwiSaver, you've got various schemes. So even though KiwiSaver rules have been set by government, it's actually implemented by a private enterprise, and each scheme is offered by a provider, and it's the big banks, and it's the big insurance companies, and it's the fund managers, and each of these schemes is actually its own kind of 401k plan, if you like.
But has it worked from where you sit when you consider it's been running out for about 5 years?
I think it's been hugely successful. I think if you look at retirement plans around the world, in terms of take-up, as I say, we've got 1.8 million members out of a potential market of, let's call it 3 million. That is a huge take-up in a very, very short period of time. So in my opinion, KiwiSaver has been incredibly successful.
But has it at the same time strangled the development of the private sector, private sector-led pension fund initiatives?
Not at all, because what's happened is it's actually spurred that, in that your private kind of company-sponsored pension industry was stagnating.
Right.
And what's happened is, because KiwiSaver was far more attractive, than those old private superannuation schemes. It's actually led to a whole new revival of the savings industry in New Zealand. And in terms of asset flows, KiwiSaver has just recently gone over the 11 billion mark. It's been a tremendous windfall for fund managers who are starting now to get regular inflows into their savings vehicles.
Cobie, would you recommend that we consider something similar here?
I mean, look, I think we've got something similar, but it's just the mechanisms that they use. You know, we've got the social challenges in this country, which you just don't have in New Zealand. Well, I mean, maybe the earthquakes will change that potentially. I mean, look at your screen now, and you'll see the kind of the inflows as far as kind of in conjunction with the New Zealand managed fund industry is concerned. And you can see how small it was in December 2007, and today KiwiSaver, as a percentage of that industry, makes up nearly 16.7%. So this is spurring on a completely different industry, which means that the asset management industry in that country and the people servicing KiwiSaver obviously, you know, benefit from this, and it creates again a compounding factor for all those businesses and so on.
Yes, that's a good way of putting it. There have been a lot of beneficiaries, not just the members of KiwiSaver have benefited. As you've mentioned, it's the fund managers have benefited, custodians have benefited, legal firms that provide legal advice to the schemes have benefited, auditing firms who need to do the scheme audits have benefited. So it has had a great knock-on effect.
Yeah, I mean, let's look at a typical balance fund. If you look at your screen now, you'll see how typically their capital is invested. You've got New Zealand up at 18% of the total equation. Those are New Zealand shares. And then you've got international shares at 32%. Yeah, that's definitely balanced. New Zealand bonds at 14%, international bonds at 18%. I mean, quite an interesting. I mean, you're seeing a big international focus here, not necessarily kind of a local focus, because kind of you see that in South Africa, big local focus, but smaller global focus.
Actually, I was doing the numbers, and actually half is international.
Yeah, I mean, why is that the case?
Well, the thinking there has been, and they acknowledge that their market is a very small market in the global context, and to get proper diversification, you really need to be invested around the world. So even though the extent to which funds invest in New Zealand is above New Zealand's makeup, say, of total share market capitalization around the world, so there is what they call a home country bias. Most of the balanced funds have most of the assets actually invested outside of New Zealand. And the other thing that they do with these funds is, for New Zealand equity mandates, they generally stretch out those mandates to include Australian shares as well.
Right.
So you see
Is that considered international?
No, that could be considered kind of New Zealand stroke Australasian or stroke trans-Tasman kind of equity exposure. Right. So that would be excluded from the international component.
You know, it's interesting because as a country you make one of two decisions. The one decision is you say, I'm going to have forced home bias. That means I'm not going to allow people to invest globally, and then you better have a market in order to do so, or you have to create other vehicles in order to create the growth. If you don't have that, then you're going to have to rely on international space. Now, South Africa, good liquidity, lots of depth in the market. You can and people can quite happily invest in this country, and you can see already, even despite that, Regulation 28 and kind of just the relaxation of exchange controls allows you to take more and more kind of capital out the country. And you'll start probably seeing, Godfrey, if we have to sit here 20 years from now, we'll probably be talking, kind of looking at balance funds which look quite similar to New Zealand funds in South Africa.
Absolutely. I was going to say to Collin, maybe on his international stuff, he needs to put in a bigger chunk of South Africa, given it's outperformed New Zealand and the other international markets.